Hey, this is Brent from Wolf on Wall Street Trade. It is January 5th, 2019. I've been covering this analog from 2007, 2008. I don't see this as a dip to be bought. I mean, you can trade it, I think. But as far as a dip to be bought, I see this as a rip to be sold. Now, if we go back and look at this analog, it's pretty remarkable. We had a first leg down, consolidation, a big second leg down, and what do we have here? 1, 2, 3, 4, 5, 6, 7 days, right, of bounce or rally. Let's go back and look at the analog. 2007, 2008, here it is. First leg down, consolidation, second leg down, 7 days into the bounce rally. Here you can see that is 2008. Again, let's move it forward to the current market. Just unbelievably, remarkably similar. I do want to touch on a couple things that were very different. Most bear market rallies, if you go back to even the late 1920s, early 1930s, most bear market rallies actually start because there's some kind of action taken by the government or the Federal Reserve. In this case, even the Federal Reserve caused this bounce. So here's what's very, very different. By this point, January of 2008, the Federal Reserve was not only not raising rates, had not only paused, but had cut rates by 125 basis points. So 125 basis points is about half Fed funds rate is right now. So they not only cut rates, but had cut them by basically what would have been 5 of the last quarter point rate hikes. So that is a very different thing than what we're seeing right now. If we walk this forward, and I'll show you what happened, we came down and retested that low eventually, which happened here, and everything improved. Internals improved, a lot of the sector performance improved, and then we got about a 16% rally moving forward, and then eventually we moved back into a downtrend. Price action is very, very similar. What yields are doing right now is very, very different. So at this point, yields were bouncing with the S&P 500 up until Friday. They were doing the exact opposite. They were moving lower. So that's something to watch into next week. I'm just saying price action is remarkably similar, but they were two very, 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 very different markets by the fact that the Federal Reserve was already cutting interest rates at this point. Friday, Powell came off more dovish. That is not the dovish pivot that I'm talking about yet. I do believe we will get the dovish pivot, and when that happens, the dollar will weaken, and you'll see some price asset inflation in dollar denominated assets, which is kind of what happened right about this period. You saw things like oil was soaring higher, gold moved higher, natural gas moved higher, dollar denominated assets. And it's not because growth moved higher, it's because the Fed was getting more dovish, the dollar was weakening. That caused dollar denominated assets to kind of reflate. So when that does happen, it's, in my opinion, not a signal to buy FANGs. It's a signal to buy assets that will reflate because of that weakened dollar, like crude oil. One final thing I want to touch on going into next week, because I do see some cool trades setting up. I've got UNG, and this is a trade just got out of right before the new year. So got into UNG on a bear flag on, what was it, December 20th? So I think that was right here, and then got out of it on December 31st, which was right here because it came down to my measured move target. Now that trade for UNG, I used options for it, so it was about a 78% gain. For UNG itself, it was about a 20% gain if you were short, or I mentioned the inverse leverage ETF, DGAS, which was up 55%. So what I've noticed is, you know, when the market gets very volatile, I'm not trying to catch a whole bunch of these little swings in here because the market's just too volatile. So I would say a couple of days a month, you get some really great setups and some swings that can make your month. You can have great trades, you know, 20, 30, 40% on some of these. UNG was one of them. So the reason we got into this, remember from the last video, UNG was very bullish on the way up. Bull flags, breaking out, consolidating, and then it came down here, broke down into a bear flag, and this is where we got in. So let me show you on a 60-minute chart real quick. That would have been right about here, and then got out of it down here on the daily chart, right coming down to 24. These were my two targets, 23, 25, and 24, so it moved down to that and took those gains. I see a lot of flags forming out there, not just bear flags like this, but bull flags too, just in kind of safe haven assets. So let's take a look at how these flags work, and I'll show you why I came up with this price target. You can count points, or on a like a log chart or semi-log chart, you can actually just do a measurement. So I am measuring the breakdown from this consolidation right to where the flag kind of started. This is not going to be exact, and this is your measured move. So the leg into this flag is pretty much what you're going to expect on the leg out, and that gave us our $24 target. UNG hit that and took the profits. Now this may turn into another bear flag kind of like this and set up another trade. It's not there yet, but I'm going to show you a couple things that I look for. Actually, let's go to crude, because this was a great one and may still be. I'm going to back this chart up to where we first got interested in crude on the short side on October 16th. Right over here. So a trend line broke. We had a first impulsive move. That is your flagpole. This is your flag. It looks like a little parallelogram that is slanting away from the preceding trend. And here's what happened next. So you get the breakdown, and watch what happened. I'm just going to walk this through quick. A bunch of flags on the way down just kept on breaking, showing no ability to hold a rally. And this was, let's see, the last one right here. And then another big breakdown into December. And now we're kind of doing something else that may be a flag. We'll get to that. So what I was pointing out Friday is what I look for in these flags. Let me see if I can zoom this out. Is a couple swings. So you need to have at least 2 swings to get these trend lines, right? And then what I like to see is it weaken on this last swing. So if we look at this, it didn't make it up to this trend line. It rolled over. Okay, and then we'll move to the next one. Here it is. Doesn't make it up to this trend line again. So what you're seeing is kind of the same thing that I was talking about with the whimper rally in the S&P 500 from early December. You get some strong rallies, or bounces, you know, because these are flags, so they got to stay kind of in this price pattern. And then you get a weak attempt, which is what we see here, or what we saw over here. That's kind of what I'm looking for. And with bear flags, that's what I look for, but bull flags kind of do the opposite. So we can look at UNG when it was acting more bullishly. Remember this bull flag in UNG when it was just like, this looks really good. Watch what happened. This was what really sold it for me, was it does not come down. On this dip, it did not come down and meet that lower trend line. So it's showing some resilience, showing some strength, and it broke out higher and kept going. So I look for the opposite with bear flags. Going back to USO, that weakness, that inability to rally again. And if we put that in terms of like the market with the S&P into December, so you get a strong rally, a little bit weaker rally, and you can really see this in small caps, and then this fizzle or this whimper rally right here that rolled over. Or in small caps, it formed this descending trend line. So a strong rally, a weaker rally, this whimper rally. It's the same concept with flags, in this case with a bear flag, and what I mentioned before with the bull flag, because there are bull flags developing out there too in some really nice looking assets, but they're not the growth stocks, they're not the FANG. They're stuff like treasuries, they're stuff like gold, they're defensive plays. So you want to know where the bull market is right now. It's in bonds, like TLT is soaring, or SHI, or gold. So there's a lot of really interesting places, but people keep trying to buy the FANG, and you know, hey, more power to them, because that gives us opportunity to sell it. Have a great week, and we'll get into some really interesting trades in the next couple days.